Right now we're in a holding pattern, waiting for the new president to be sworn in approximately January 20th. And he has already proposed and will be proposing formally tax cuts and spending increases to the tune of $650 billion to $1 trillion. So you're looking at probably a government deficit next year of about $1 trillion, and 2010 about $800 billion, and that has a tremendous stimulating effect on the economy. And in economics, we call that there's something called the multiplier effect, where a dollar that you spend or the government spend multiplies, because not only do you spend that money or the government spend that money, but then the person you spend it on, they continue to spend it. So there's what we call a multiplier effect to spending. So all of that will work to improve the economy. You have a $13 trillion economy, and you have about $3 trillion of stimulus going into it. Another aspect that's going to be a little different in this recession is that the global economy is still slightly growing. You had growth in India and China in the 8% and 10% a year range. Right now maybe it's only 1%, but they're still growing. And that's something we didn't have before, is some additional growth in the emerging markets. So that's also a positive. So now we looked at the overall perspective of where things are. Let's look a little more at how we got here and what were the corporate strategies that were employed by the banks and financial institutions that got us into this problem. In terms of recovery, we're looking at starting to come out of the recession in late 2009 and in 2010. And there are some forecasters, good ones, who are projecting a strong recovery based on the amount of stimulus being put into the economy. So let's go back to how we got to this mess and what were the combination of factors. MIT professor Charles Kindleberger called financial crisis a hardy perennial. Means a flower or plant that blooms every few years. And each of these episodes was preceded by a combination of the following. Rapid rise in asset prices, not fully justified by underlying economic fundamentals. Rapid growth in financial liquidity, like low interest rate, financial innovation, and a sharp increase in debt. And that has been true in the 18th century, the 19th century, 20th century, and now the 21st century. The most classic case was the tulip bulb bubble in Holland, where the price of tulip bulbs kept going up and up and up to the point where they were worth more than a house. Basically, people would buy a tulip bulb expecting it to reproduce and therefore being able to sell the progeny at a profit. But of course, that ended at a certain point when no one could afford the tulip bulb, and at the end of the day, the flowers produced by the tulip bulb weren't that valuable. But there was a tremendous speculation. There was also what's called the South Sea bubble, and we can remember in 2001 the internet bubble, where internet companies were growing infinitely and had little or no cost. And some of them have done really well, like Google. But by and large, many of the companies that were promised to do so well didn't end up doing as well. But there was a suspension of disbelief, and as prices of the stocks went up and up and up, it became a self-fulfilling prophecy as people piled on, just hoping to buy and sell quickly. But there was an additional aspect of this that wasn't just a rapid rise in asset prices. We also had a lot of help from the government. A lot of things the government did made this bubble much more likely. You could go back to actually our very esteemed Federal Reserve Chairman Alan Greenspan, who called the stock market bubble irrational exuberance and said that stock prices were too high. But in terms of the housing prices, he never said that. He actually encouraged housing prices to go up, and he never really talked about that housing prices were too high compared to income. Another aspect of what government did was the changes in securities laws that were very important. One was that the liability for selling securities was reduced. A second was a process called securitization, where banks and other companies could make a loan, have lawyers and accountants package those loans into a bundle of securities and sell them to investors or insurance companies, pension funds, and so forth. This had the very positive effect of bringing additional liquidity into the market, but became very, very abused. And this was combined with a very lax regulation of the companies that decided whether these investments were safe, which were the rating agencies. And we're going to take a little more look at the rating agencies, and basically they didn't do what they were supposed to do in terms of reviewing and analyzing these securities. Meanwhile, investors were absolutely depending on their ratings to determine whether they should invest or not. So you had a combination of government factors and legal factors that created a very large loophole for people who wanted to make a lot of loans and collect a lot of fees and not worry about whether they got paid back or not. And people with a high animal instinct, Brenda's greed factor, will always find the loopholes and patch them together to create short-term income for themselves. So let's look a little further at some of the, in one case, this is we're going to look at two cases. One is what I call an embarrassing case study, Washington Mutual. This was in the New York Times actually this weekend. And it gives you a real good glimpse into what was going on at WAMU and some of the other banks recently. Kerry Killinger, the CEO of Washington Mutual, said, "We hope to do to this industry what Walmart did to theirs, Starbucks did to theirs, Costco did to theirs, and Lowe's and Home Depot did to their industry. And I think if we've done our job 5 years from now, you're not going to be calling us a bank." Well, it's true. You don't call WAMU a bank anymore. It doesn't exist. It's part of J.P. Morgan Chase. Here's an example that they give. At one mortgage processing center in San Diego, John Parsons, who was accustomed to seeing babysitters claiming salaries worthy of college presidents and school teachers with incomes rivaling stockbrokers, rarely questioned those salaries. In one case, there was a gentleman claiming a six-figure income, and he had an unusual profession. He was a mariachi singer. It's a singer of Mexican songs. Usually not someone who has a six-figure income.